The day you become self-employed, the government does not suddenly decide to punish you. It simply stops hiding the meter. That is what shocks most people. Not the tax itself, the honesty of it. When you were an employee, half of the payroll tax was taken from you before you ever touched the money, and the other half was paid quietly by an employer you barely thought about. The meter was running then too. You just did not have to watch it. The moment you go out on your own, you become both sides of the arrangement. Now you are the worker and the employer. Now you are the person producing the income and the person responsible for feeding the system behind it. And suddenly what felt manageable as a W-2 life starts to feel brutal as a Schedule C life. That is why so many self-employed people feel ambushed. They say, I only made $50,000. Why does my tax bill feel insane? Because they are staring at 3 layers of reality at once: federal income tax, state tax, and a high-tax state. If they live in one, and then the part that hurts in a uniquely personal way, the self-employment tax, the full Social Security and Medicare burden that used to be split into a visible half and an invisible half. Now both halves have your name on them. Most people respond to that pain the wrong way. They become obsessed with hunting deductions, entities, side structures, internet tax tricks, real estate threads, LLC videos, and formula-driven S-corporation myths. They spend years trying to lower the wrong number, and the labor meter keeps running the whole time. That is the trap. You think you have a tax strategy problem. What you really have is a tax-based problem. If you do not understand what the self-employment tax is actually attached to, you can spend the next 5 years decorating the outside of your business while the meter in the basement keeps spinning. I have spent my whole life looking for the hidden mechanism underneath the story people tell themselves in markets, in managers, in acquisitions, in incentives, and certainly in taxes. The public story is almost always softer than the real one. The public story says, form the right entity, buy the right property, find the right deduction, and you can make the pain disappear. The real story is much harsher. Self-employment tax is tied to active income. That is the center of the whole machine. As long as the income is coming from your labor, your judgment, your time, your direct activity in the business, the labor meter is alive. It does not care that you are tired. It does not care that you opened a shiny new entity. It does not care that some video promised a loophole. It cares about what the income is. It cares about why the income exists. It cares whether the money is a return on your work or a return on capital. That distinction is not cosmetic. It is the whole battlefield. Most self-employed people never really learn that. They stay emotionally trapped at the surface. They chase strategies that sound sophisticated because sophistication feels better than accepting the plain truth. When your income depends on you showing up, the meter is built into the arrangement. That is why the first thing I would tell any self-employed person is not how to reduce the tax. It is to stop lying to yourself about what kind of income you are earning. If the business stops when you stop, the meter is not confused, you are. Once you understand that, a lot of bad strategies collapse in a single afternoon. Take real estate. People hear that real estate is tax efficient and immediately imagine it as a universal solvent. They think that because real estate can be useful for income tax planning, depreciation, long-term appreciation, and timing, it must somehow also wash away the self-employment tax that is being created by their consulting income. Agency income, coaching income, practice income, design income, or other active business profit. It does not work that way. Buying a rental property does not reach back into your active business and erase the labor meter. It does not retroactively transform your Schedule C profit into something else. If you already created active earnings with your hands and your time, that meter has already been attached to that income stream. This is one of the biggest confusions in money. People constantly mix together different tax problems as if they are the same problem. They are not. Income tax planning and self-employment tax planning overlap in places, but they are not twins. They are not interchangeable. A strategy that helps one does not automatically help the other. If you do not understand which battlefield you are on, you will keep bringing the wrong weapon. Real estate can be a useful weapon on one battlefield. That does not mean it wins the war you are actually fighting. Then comes the LLC fantasy. I have watched people talk about LLCs as if a filing cabinet at the Secretary of State's office has mystical power. It does not. An LLC can matter for legal reasons, it can matter for liability structure, it can matter for operations. But people hear 3 letters and imagine transformation. They think the moment they create an LLC, the labor meter will get confused. The IRS will become gentle and the active income will somehow stop being active. Number A1 owner LLC is, by default, ignored for federal income tax purposes. You can wrap the business in a new jacket, but the body underneath is still the same. You are still a sole proprietor for tax purposes unless something else changes. The labor meter keeps running, and if you have a multi-member LLC, the misunderstanding often just takes a new form. People assume partnership automatically means escape. It does not. Active partnership income can still be exposed to self-employment tax. Again, the system looks through the story and asks the harder question. What is this income really? Who produced it? Why does it exist? That is why I call this the wrapper illusion. Average people love wrappers because wrappers feel like progress, new logo, new entity, new checking account, new bookkeeping subscription, new operating agreement. They feel movement, so they assume they created change. But wrappers are not engines. A wrapper that does not alter the character of the income is just nicer packaging around the same labor meter. You can waste years inside that illusion. Then you meet the third trap, and this one destroys a lot of intelligent people because it feels logical. I call it the wrong base fantasy. One spouse has a profitable active business. The other starts something new that loses money. On a napkin, the family thinks, we made money here, we lost money there, so surely the tax pain should disappear. They are thinking in one combined household story. The self-employment tax does not always think that way. It looks at who earned the active income. It looks at whose business created the self-employment exposure. That is a brutal lesson because families budget jointly, dream jointly, suffer jointly, and pay bills jointly. But the tax base for self-employment is not simply a family feeling. It is tied to the specific person and the specific active earnings that generated the liability. So the husband with the medical practice is still carrying the labor meter on his business income, even if the wife launched a software venture that produced heavy losses. Those losses may matter for income tax on the joint return. They do not magically dissolve his self-employment tax. This is what I mean when I say most people are fighting the wrong war. They do not understand the base. They keep trying to offset a shadow on the wall when the real machine is 3 floors down. And because they do not understand the machine, they become vulnerable to every glossy promise in the marketplace. Someone tells them to buy real estate. Someone tells them to open an LLC. Someone tells them to make a family shift. Someone tells them to elect S-corporation status immediately at any income level. Someone tells them there is a secret percentage they should pay themselves. Someone tells them the whole problem is just deductions. Most of what they are hearing is marketing dressed as planning. Planning begins with mechanics. If you cannot explain what causes the tax, you are not planning, you are guessing in expensive clothing. Now here is where the conversation becomes useful. There are real levers, not many, not magical, not universal, but real. The first real lever is what I call the capital return exception. This is where people finally start to see the line the system has been drawing all along. Under the law, a bona fide limited partner's distributive share of partnership income is generally treated differently from the earnings of someone actively working in the business. Why? Because the income is being analyzed as a return on invested capital rather than compensation for services. That difference matters if the money is paying you because your capital is at risk. That is one thing. If the money is paying you because your effort is in the room every day, that is another. You cannot fake this with vocabulary. You cannot just call yourself passive because you want the result. Legal status matters. Economic substance matters. State law matters. Functional reality matters. Are you truly a limited partner? Are you genuinely limited in participation and management? Is the income properly characterized as a return on capital, rather than a paycheck wearing better shoes? That is why this lever is real but narrow. It is not a costume. It is a structure. And structure is the only thing that ever really changes outcomes. The second real lever is what I call the two-hat switch. This is where the S corporation enters the conversation, and this is also where more nonsense gets sold than almost anywhere else in small business tax planning. In an S corporation, you wear two hats. One hat is worker, the other hat is owner. The worker hat must be paid reasonable compensation for the actual services performed. That wage is still exposed to payroll tax, which is economically the same burden people are trying to understand in the first place. The owner hat can receive distributions, and those distributions are treated differently. That sounds attractive, and sometimes it is. But here is what the internet rarely tells you, because restraint is not good for clicks. Timing matters, scale matters, profit matters, substance matters. If the business is too early, too small, too thin, or too unstable, electing S corporation status can give you more compliance costs, more administrative friction, more payroll obligations, and very little real benefit. Why? Because there may not be much profit left after a reasonable salary. If nearly all the economic value is still coming from your labor, then the labor meter has not really been defeated. It has just been rearranged across a more expensive structure. I want you to hear that clearly. A structure is not valuable because it sounds advanced. It is valuable because there is enough economic room inside it to matter. That is why I have no patience for lazy formulas. Pay yourself 30%, pay yourself 40%. Use this simple ratio. That is not serious planning. Reasonable compensation is not a superstition or a percentage meme. It turns on what would ordinarily be paid for similar services by similar enterprises under similar circumstances. The value of the work drives the wage. The profitability of the business does not give you a blank check to pretend your labor suddenly became cheap. As profits rise, distributions can rise. Wages do not automatically rise in lockstep. That is the opportunity. But the opportunity begins only after you respect the work, price the labor honestly, and leave yourself genuine excess earnings beyond that. That is why I call it the two-hat switch rather than the easy escape. If you only have one real hat because the business is still almost entirely your labor, then you have not yet earned the second hat in an economically meaningful way. The third real lever is the one people talk about most but usually execute worst. I call it the same busyness rule. Yes, deductions can matter. No, they do not matter, simply because they exist. People act as if every expense is a magic eraser. It is not. A deduction only changes the labor meter when it actually reduces the net earnings from self-employment for the same taxpayer inside the active trade or business that generated the exposure in the first place. That is the part people skip because details are not exciting. Retirement plans can matter. Health insurance can matter. Accountable plans can matter. Depreciation can matter. Benefit structures can matter, but only when they are implemented correctly, matched to the facts, appropriate for the stage of the business, and attributable to the actual business producing the self-employment income. This is why serious planning so often sounds less glamorous than fake planning. Fake planning promises a trick. Real planning demands a map. If you do not know which business owns the income, which taxpayer earned it, which expenses are properly attributable to it, and at what stage the business can support more advanced structures, then you are not lowering a tax with precision. You are tossing receipts into the air and hoping one of them lands on the right number. And hope is not a tax strategy. The psychological damage of misunderstanding all this is larger than most people realize. When self-employed people feel crushed by taxes, they often start making emotional business decisions. They undersave because the bill shocked them. They over-withdraw because they feel the business owes them. They buy shiny tax theme products because they are desperate for relief. They resent growth because more profit feels like a bigger punishment. They start chasing complexity not because complexity serves them, but because pain makes people superstitious. That is a terrible way to run a business. You begin by selling your judgment to the market, then you end by abandoning judgment inside your own finances. I would rather you face a hard truth than hide inside a soft lie. The hard truth is this: self-employment is expensive because active income is expensive. You are not just making money, you are producing it directly. The system sees that. The labor meter sees that. The bill feels heavier because the hidden half is now visible and the withholding illusion is gone. The tax did not become monstrous overnight. Your relationship to the tax became honest. That honesty can either mature you or break you. If it matures you, you start thinking like an allocator. You stop asking, what rumor can I use to make this number disappear? You start asking, what type of income am I actually earning? What stage is this business in? Is there enough profit for a real two-hat switch? Am I truly creating capital returns anywhere? Or am I still living almost entirely inside labor returns? Which deductions truly belong inside this business and reduce the correct base? What needs to be built first before advanced planning is worth the cost? That is adult thinking. That is owner thinking. That is how you move from panic to control. Most people want tax relief without business maturity. They want owner outcomes with worker economics. They want distributions before there is enough surplus. They want passive treatment while remaining deeply active. They want deductions from the wrong pocket. They want entity benefits without structural change. That is like wanting the fruit without planting the tree. I am not telling you this to make you more cautious. I am telling you this because precision is more liberating than fantasy. Once you understand the labor meter, you stop wasting energy on strategies that were never going to move the needle. You become harder to sell to. You become less emotional. You stop confusing wrappers with engines. You stop treating every deduction as equal. You stop electing structures just to feel sophisticated. You stop using gross revenue as proof that the business is ready for advanced planning. You begin to build in sequence. And sequence matters. First understand the income, then understand the base. Then understand the real levers, then act when the economics justify the move. That is the order. Not because the government is kind, because reality is, I have no issue with someone using every legal lever available. In fact, I admire disciplined planning, but I do not admire wishful planning. I do not admire business owners who know every online slogan and still cannot explain why they owe what they owe. I do not admire complexity that arrives before scale. I do not admire people who spend thousands building structures to save hundreds because they wanted to feel clever. Cleverness without arithmetic is vanity, and vanity is expensive. There is also a deeper lesson hiding under all of this, one that reaches beyond taxes. As long as your economic life depends overwhelmingly on active labor, you will live closer to the labor meter than you think. That does not mean self-employment is bad. It means self-employment is a stage, not a halo. A lot of people romanticize being on their own. They talk about freedom and flexibility and independence. Then tax season arrives and they discover that independence without structure is just exposure wearing a nicer smile. Freedom is not the absence of a boss. Freedom is the presence of systems. Freedom is having income streams that are not all screaming for your time at the same moment. Freedom is building enough surplus that structure actually changes what is possible. Freedom is when capital begins to carry part of the load. That is why the most important thing I can say to a self-employed person is not merely lower your taxes. It is grow up financially faster than your revenue grows. Because if revenue grows faster than understanding, you do not become rich. You become fragile at a higher income level. You become the person making more, paying more, fearing more, improvising more, and still wondering why the money never feels as free as it should. I do not want you to become that person. I want you to become someone who can look at an income stream and immediately know whether it is labor, heavy, capital, heavy, scalable, fragile, early, stage structure, reedy, or still too dependent on your body and your calendar. I want you to know the difference between tax planning and entity theater. I want you to know when the S corporation is a genuine advantage and when it is a premature costume. I want you to know that a deduction is only powerful when it strikes the right base in the right business for the right taxpayer in the right way. That kind of clarity is not sexy. It is worth far more than sexy because clarity compounds, confusion compounds too. One leads to intelligent structure. The other leads to years of expensive movement that goes nowhere. So here is the test. When you look at your business right now, are you reducing the labor meter, or are you just talking around it? Are you building capital returns, or are you still relying almost entirely on your presence? Are you using a structure because the economics justify it, or because the internet made it sound smart? Are your deductions actually changing the right base, or are you just collecting expenses and calling it planning? Are you becoming an owner, or are you staying a worker with better branding? That is the door in front of you. Most people will not walk through it because the truth on the other side is uncomfortable. It tells them they are earlier than they wanted to believe. It tells them the shortcut is not real. It tells them their problem is not that the tax code is unfairly targeting them. Their problem is that the labor meter is still attached to the way they make money. But if you can face that without flinching, you gain something more valuable than a trick. You gain control. And once you have control, the next move becomes obvious. Stop trying to hide from the meter. Build a business that can survive it, justify better structures, and eventually lean less on your direct labor. That is when planning stops being cosmetic. That is when tax strategy becomes capital strategy. That is when self-employment stops feeling like a constant ambush and starts becoming what it should have been from the beginning, a stage on the way to ownership, not the final destination.